You open up a brokerage app on your phone, and instantly you're staring at PE ratios, bid-ask spreads, and market caps. You freeze, close the app, and tell yourself you'll figure it out later. But later never comes. Today, we are skipping the noise. In the next 5 minutes, you are going to open an account, buy a piece of the 500 largest companies in the United States, and put the entire process on autopilot. To do this right now, you need 3 things: your checking account routing number, your first $100, and a timeline of decades. Completing this 5-minute setup moves your capital from a stagnant account and into a position to capture market growth. Let's start with the foundation. Step 1 is getting your money to the market. Download a reputable zero-commission brokerage app. Fidelity, Vanguard, or Charles Schwab are all excellent options that won't charge you fees to trade. Once you create your login, navigate to the transfer section. Link your external checking account, type in $100, and hit transfer. This chart compares your bank's typical interest rate to standard inflation. If that money stays in your checking account, it earns maybe 0.01% a year, while inflation eats away at its purchasing power. Physically moving this cash into your brokerage account stops that slow bleed. You've positioned your money to actually grow. Now that your account is funded, go to the search bar in your app and look for an S&P 500 index fund, or ETF. Instead of picking one stock and risking everything on a single business, an S&P 500 fund lets you buy a fractional instant slice of Apple, Microsoft, Google, and 497 other major companies all at once. Over a 15-year period, nearly 90% of highly paid professional fund managers failed to beat the simple index. That is exactly why Warren Buffett recommends that the average person should just buy a low-cost S&P 500 index fund and hold it forever. But there is a specific trap you have to watch out for. Wall Street makes its money by charging you management fees, and actively managed funds will quietly siphon away your returns year after year. Before you buy, scroll down the fund's profile page until you find the term expense ratio. This is the annual fee they charge you. You want to make sure this number is below 0.1%. This chart tracks $10,000 invested over 30 years at a 7% return. The top line has a 0.1% fee. The bottom line has a 1% fee. That tiny percentage difference costs you almost $15,000 over 3 decades. By choosing a maximally diversified, exceptionally low-fee fund, you keep your money working for you rather than paying for a fund manager's yacht. Step 3 is making the actual trade. Tap the Buy button on your selected S&P 500 fund. The app might ask you to choose an order type. For highly liquid index funds with millions of shares traded daily, you just select a market order, which buys the stock immediately at the current price. Type in your $100, double-check that it's set to a market order, and hit Submit. Your screen will instantly generate a confirmation receipt. Check your main portfolio tab, and you will now see your new shares listed under your total balance. Hitting Submit officially converts your cash into equity. Your financial progress is now linked to the productivity of these 500 companies. Now we set up the engine to run without you. Navigate back to the app's main menu and look for a tab labeled Recurring Investments or Automatic Transfers. Create a new rule. Tell the app to pull exactly $100 from your checking account and buy that exact same index fund on the 1st of every month. This strategy is called dollar cost averaging. It takes the guesswork out of timing the market, and more importantly, it entirely removes your own emotions and potential panic from the equation. Look at this graph showing market volatility. Because you are investing a fixed amount on a strict schedule, your $100 naturally buys fewer shares when the price is high and automatically buys more shares when the price drops. You don't have to bravely log in and buy during a terrifying market dip. Your account does it for you, acquiring assets on sale while everyone else is selling. You've done it. You own a piece of the 500 strongest businesses, and you have an automated system diligently buying more of it every single month. The only maintenance required from here is scaling. Whenever your income goes up, whether from a new job or a yearly raise, log back in and bump that monthly contribution up by $50 or $100. Then close the app. Turn off the financial news, ignore your coworkers' hot stock tips, and let the market fluctuate. Check your portfolio maybe once a quarter, just to make sure the transfers are still running. Wealth is built by consistently acquiring good assets, leaving them alone, and letting compound interest quietly do the heavy lifting for the next 20 years.